Hello everyone, welcome back to another quick revision lecture for ACCA's paper F9 Financial Management, and the topic we are going to discuss in this video is called as foreign exchange risk. Foreign exchange transactions in the global environment are very common now these days, so it's very important that you hedge your risk, you prevent yourself from risk in currency appreciation and depreciation depending on whether you are an exporter or importer. So we'll discuss all of these things in detail. We'll understand the techniques to hedge the risk after we understand what the risk is, but that too we will discuss after we have understood some basic principles, some basic concepts of foreign exchange transactions. Okay, so we'll start with the basics because this is a chapter that confuses a lot of students, but once your conceptual clarity is there, once you understand this foundations of the chapter, this is one of the easiest marks you can get. Very no-brainer type of chapter. So let's get started. Firstly, we'll again, as I mentioned, we'll start from ground up. So if you know something, well and good. If you don't know something, pay attention. The way foreign exchange transactions are quoted is, one thing is called as a quotation. It is represented as $1. For example, I have taken here $1 is equal to 90 INR. So in this case, you will have one as base currency, another one as a counter currency. The currency which is denominated in one unit is called as the base currency. Okay. So in any quotation, either currency can be the base currency depending on which one is denominated in one unit. So I can have INR as the base currency in a quotation. The same quotation can also be represented as 1 rupee is equal to 1 by $90. Now this is the same exchange rate. Just rupees is the base currency now and dollar is the counter currency. Okay. In this transaction, dollar is the base currency and rupees is the counter currency. Very important to know because in your IRPT formula, your PPPT formula, all these formula, it is very important to know that you understand what the base currency is. Now, what you see here, the quotation that you see here, it is a classic one-way exchange quote. When banks deal with another banks, this is the exchange rate that they give. When banks are dealing with other banks, they are not charging profits to other banks, they are charging a common rate. Okay, so this is a one-way exchange rate. But when bank is dealing with you, when bank is dealing with a customer, a company, at that time they have a different rate to sell a dollar, they have a different rate to buy a dollar. Okay, so when bank is dealing with a normal customer, so that time they use a two-way exchange rate which is represented something like, let's say $1 is equal to 89 rupees to 91 rupees. 89 rupees to 91 rupees. Now one of this rate bank will use to buy, another rate bank will use to sell. A very easy way to remember is that left side is smaller, bank will buy low, bank will sell high. You can ratify this, but again, conceptually also this is what makes sense. Bank wants to earn profit. The difference between these two rates is called as spread. Bank will buy at a rate which is convenient to it. Bank will sell at a rate which is more convenient to it. Okay, so bank will always buy low, bank will always sell high. This is called as a two-way exchange rate. So oftentimes students, when they are dealing with forward rate contract, they are dealing with money market hedge, they are dealing with futures, they get confused which rate to pick up for a particular translation. They want to transfer from dollar to pound or pound to dollar or dollar to yen, yen to pound. Either ways, they confuse that out of the two rates which one to. They remember ki, okay, bank buy low, bank sell high. Then they forget, however, which a lot of teachers maybe at times try to get you to rot learn this thing. If you are an exporter, use this. If you are an importer, use this. How? Very simple three-step process. You have to know. Step number one, understand what is the base currency. Pick out the quotation. The quotations would be given in the question. What is the base currency? Okay, in this case, we have the dollar as our base currency. Now ask yourself, what is bank doing with the base currency? Okay, because the confusion comes is because you say that bank buys low, bank sells high. You are selling one currency, bank is buying that currency. Bank is selling another currency, bank is purchasing one currency. At the same time, bank is buying one currency, bank is selling one currency. Which currency to take? Which buy or which sell to take? Confusion. Simple. Pick out the base currency. So in this case, you have dollar, the currency which is given in 1 unit. Pick out the base currency and ask yourself, what is bank doing with the base currency? Forget everything else, just think what the bank is doing with the base currency. If bank is buying the base currency, then in that case, you rate the buy rate, you use this rate. If bank is selling the base currency, then you will use this rate. I'll give you an example. Let's say you are an exporter. From India, you are an exporter. You are selling goods to foreign customers. You are receiving $1,000. You are receiving $1,000. Now, using the method that I have said, what is the base currency? Dollar is the base currency. What will bank do now? You are entering into a transaction. What will bank do now? So see, you will receive dollar from your customer. You will give it to the bank. Bank will buy the base currency. Bank will buy the dollar. Bank will buy the dollar. Bank is buying the dollar. Bank is selling the rupees. Bank is selling the rupees. Okay. So in this case, you will take 89. Now let's say the quotation was given differently. So now this brings me to the another point. How do you reverse the quotation? In this case, I did it very simply. 1 rupees is equal to 1.90. In a two-way exchange, how do you change the base currency? How do you change the base currency? You take 1 rupees is equal to, you reverse just like this, you reciprocal this one. Okay, so you can take 1 upon 89 to 1 upon 91. Can you do this? No. Why? Because 91 is bigger and base currency and your buy rate is always on the left side. Buy rate is always on the left side. So 91 is bigger denominator. So this one is smaller. So this one would be, you will reverse it, you will inverse it, but you will also change the sequence. So this will be here and this will be here. So 1 by 91 to 1 by 89. 1 by 91 to 1 by 89. If this was the quotation given to you, then what will you do? You will say, okay, what is bank doing with the rupees? So you are the exporter, you got dollars, you sell dollars to the bank. Bank is buying dollars. If bank is buying dollar, then it is selling rupees. If bank is selling rupees, bank will take this rate. It's the same rate. It's the same rate. But in this case, when quotation is given in base currency is dollar, that time you take buy rate. When base currency is rupees, that time you take sell rate. That time you take sell rate. Clear enough? Clear enough? I hope it is. Okay, so we've discussed two-way exchange rate. We have discussed changing the base rate. We have discussed the changing the base rate. Again, when you are selling a currency, bank is buying that currency. Okay, and at the same time, the other currency, bank is in that case selling that other currency, and you are then in that case buying that currency. Okay, so it goes reverse. It goes reverse. Bank is selling one currency, bank is buying one currency, and the same currency that bank is buying, you are selling, and the same currency that bank is selling, you are the one who's buying that currency. Okay, now we discuss home currency and foreign currency. See, home currency is the currency that the home currency is the currency of the country in which you are operating, in which the company is operating. Okay, it is the currency of country in which the company operates. All other currencies are foreign currencies. All other currencies are foreign currency. But in calculating and identifying the buy rate or sell rate, what you are going to see? You are going to see base rate and counter rate. It can happen that your home currency is rupees, but the base currency is dollar. It can happen that your home currency is rupees and the base currency is also rupees. So you have to always go by the base currency in this case. What is bank doing with the base currency? What is bank doing with the base currency? Whether bank is buying the base currency or whether bank is selling the base currency. If you understand just this much, entire chapter is easy. Okay. Now, we talk about currency movements. These currencies are traded in market. There are three types of market. Basically, there are three types of exchange rates: fixed exchange rate, floating exchange rate, and managed floating exchange rate. In a fixed exchange rate, the currency is tagged to a single other dominant currency or a mix of different various currencies. For example, a currency would be tagged to US dollar or euro or GBP or maybe a mix or index of these 5 currencies in total, right? So that is fixed exchange rate. Free floating exchange rate system is a market in which exchange rates are completely based on demand and supply. Exchange rate, the value of a currency is completely based on demand and supply of that currency. And then in managed floating, which is also called as dirty float, it is a mix of demand and supply plus fixed exchange. And managed floating, what you do is you let demand and supply run the currency in a particular range. When the currency is, let's say, going in a very different direction, and that time you will maybe sell the foreign currency or buy the foreign currency, thereby impacting its demand. The central bank of the country, will impact the demand and supply of foreign currency and home currency to change the exchange rate and get it back in a particular range. China does this very often. China does a very dirty float. So China, for couple of decades, China had over depreciated its asset, over depreciated its currency, because then it becomes cheaper for other countries, because then it becomes cheaper to sell goods in other countries, and therefore you will see the entire global supply chain is right now heavily dependent on China. The exports of China are great because they depreciated. The product is good, but secondly it depreciated its own currency to a great extent. Okay, now we discuss appreciation and depreciation. If if you can buy if you can buy more counter currency, with the same base currency, okay, you're dealing £1, you have £1, it gives you $1.6. If, let's say, exchange rate changes and in £1 now you can buy $1.7, in £1. In that case, you can buy more dollars with the same amount of pound. Therefore you will say that pound has appreciated. But at the same time, the counter currency, the other currency has depreciated. Okay, now in terms of dollars, you will see this $1 is equal to 1 by 1.6, and then $1 is equal to 1 divided by 1.7. 1.7 is smaller than 1.6. So in $1, earlier you could have bought 1 divided by 1.6 pounds. Now you can only buy 1 divided by 1.7 pounds. So you will say that dollar has depreciated. Your dollar has depreciated. Okay, now what is the impact of these exchange rates on business and on transaction? If you are an exporter, okay, you are an exporter, and foreign currency appreciates, so let's say you are going to receive, you are from India, you sold certain goods in USA for $1,000. So now you are going to receive for $1,000. $1 was equal to 85 earlier. Now $1 is equal to 90. So earlier you would have received 85, but now because dollar has appreciated, you would have received earlier 85,000. Now you are going to receive 90,000. Because dollar has appreciated. Correct? So as an exporter, when foreign currency appreciates, you are in favorable scenario. The exact opposite happens for an importer. An importer, earlier the dollar was one, you had purchased the goods for $1,000. Earlier you had to pay $85,000. Now you will have to pay $90,000 for the same amount of, now you will have to pay 90,000 rupees for the same amount of dollar. So for an importer, the situation is adverse. The exact opposite happens when foreign currency depreciates. When foreign currency depreciates, the receivable of the exporter decreases. So it is a adverse change for an exporter, but for an importer it is a favorable change. And this is what when foreign currency appreciates, your home currency is depreciating. Foreign currency is appreciating, then other currency, the home currency, is depreciating. This is what China used to do. China used to depreciate its own currency by increasing its supply in the market, so that exports become favorable, so that exports increases, because Chinese goods will now become cheaper for rest of the globe. Okay, now exchange rate systems we have discussed. Now Because of exchange rate movements, there are three types of risk. There are three types of risk. Because of exchange rate changes, there are three types of risk. Number one is transaction risk. I sell a good here. I sell a good here for $1,000. In future, right now $1 is equal to 85. Okay. In future, 3 months later, when the receivable is going to come to me, $1 gets equal to 80. $1 gets equal to 80. Now the amount is same, the dollar amount is same, but here I would have received 85,000. Here I'll only receive 80,000. This is transaction risk. Transaction risk is that exchange rate will change between transaction date, this is your transaction date, and settlement date when actually cash comes in. This is your transaction risk. Economic risk is more broader. Economic risk is more broader. If you're following news, you would know that Trump had increased tariff on India compared to the. So economic risk is that because of exchange rate changes, your goods or your import becomes either expensive or less favorable to the foreign customer. As an exporter, the problem is if the exchange rate, your currency appreciates, then your goods become expensive to the foreign customers. So this is an economic risk, or this is called as a direct exposure. Adverse change in the home currency, your adverse change in your home currency. Your home currency in this case has appreciated, so this is an adverse change for your exporter. For an importer, if the home currency depreciates, then it is an adverse change, because when you are purchasing, the raw material gets more difficult, the raw material gets more expensive. This is a direct exposure. Indirect exposure is, let's say you and China, a Chinese company and you both are competing in US market. Your currency is stable. Indian currency to US, the exchange rate between India to INR to USA is stable, but Chinese currency depreciates. So now Chinese goods are comparatively cheaper. They can compete more in US market. So this is indirect exposure to, again, economic risk. Transaction risk is relevant to particular transaction, it is short term. Economic risk is broader business risk because of exchange rate changes. And lastly, the type of forex risk that you face is translation risk. This is a notional risk. This is not actual risk. This is a notional risk. In translation risk, what happens is you have a foreign subsidiary. It will prepare books of statements as per in the foreign currency. Okay, all the things are normal. But when you are going to report consolidated statement of your financials, consolidated books in your home country, you will take the foreign currency books, and you are going to change it to your home currency. In that, sometimes it will show a distorted image of your foreign subsidiary, of your foreign financials. Now this is purely an accounting risk. Actually there is no cash flow. In exchange risk and in your transaction risk and economic risk, you have actual cash risk. You have to pay here. You are going to receive 5,000 less here. You're going to receive 5,000 less here. Your goods supply demand is going to change. Actual transaction risk, actual cash flow risk. But translation risk is purely notional. It is accounting risk, not actual cash flow risk. Okay. Now we discuss something called as Forex market. There is spot market and there is forward market. In the spot market, you can buy and sell the currency in the moment right now. The exchange rate that goes on in the spot market is called as spot rate. Okay, so spot rate, all the things are happening right now, real time. Then you have something called as forward market. In forward market, you can buy and sell the currency at a future date. At a future date, you can buy and sell the currency at a predetermined rate. So you agree the rate of exchange for the future. This is called as forward market. Okay, this is called as forward market, and forward rate is the rate that you decide in the forward contract. The rate you decide in the forward contract. Now, how do you get this forward rate? How do you get this forward rate? There are two important theories for this. One is called as purchase price parity and another one is called as interest rate parity. Purchase price parity says that there is law of one price. That is, the same good or service in a particular country will cost the same in another country regardless of which country you are buying. So for a purchaser, for a customer, whether you buy it in USA or whether you buy it in India, let's say you are from India, whether you buy from USA or whether you buy from India, the cost is going to be same. The inflation will not have any impact. So let's say this pen costs $1. This pen costs $1. Okay, and in India this pen costs 90 rupees. This pen costs 90 rupees. So your exchange rate today will be $1 is equal to 90 rupees. Now what purchase price parity theory says that, let's say the inflation rate in India is 10%. The inflation rate in India is 10%. Okay, 1.1, and inflation rate in USA is only 5%. Inflation rate in USA is only 5%, 1.05. What it says is that after inflation also, ideally what you would do is it is cheaper in USA, so let's go and buy in USA. But it says that during the time of this inflation, the exchange rate will change in such a way that whether you buy it in 99 in India or whether you buy it for $1.05 in USA, the cost to you will be same. Let's see this for an example. Purchase price parity theory says that $1 multiplied by 1.05 will be equal to 90 into 1.1. Therefore, your $1 will be equal to 90 into 1.1 divided by 1.05, and therefore this will be equal to 94 point, let's say 23. Okay, now in Indian currency, if you would have purchased this, it would have been 99 rupees. Let's say you purchased it in $1.05. Let's say you purchased it in $1.05 because inflation was lesser over there. It looked cheaper. But the exchange rate has now changed. When you do this, for this $1.05, when you convert this into rupees, ultimately you still get 99 rupees. You still will have to give 99 rupees. You'll still have to give 99 rupees even though inflation was lower in USA. This is called as purchase price parity theory. Now when you convert this thing into a formula, it looks something like this. Your future spot rate is going to be current spot rate is 90 multiplied by 1 plus inflation of counter currency. Rupees is counter currency, so inflation of rupees divided by 1 plus inflation of base currency. 1 plus inflation of base currency and 1 plus inflation of base currency. Okay, so this is your current spot rate, and you want to find the spot rate of year 1. You want to find the spot rate of year 1. If it was for 6 months, then 6 monthly spot rate, the inflation you will only take 6 monthly inflation. You'll only take in that case 6 monthly inflation. Okay, this is your purchase price parity formula. The exact same happens with interest rate parity. The exact same thing happens with interest rate parity. In that case, what it says is that the same amount of capital will generate the same amount of return whether it is invested in USA or whether it is invested in India. Whether it is invested in one country or another country, the rate of interest, even if the rate of interest is different, it will generate the same amount of return. So let's take the same example again. I have $1 to invest, which currently I can invest either in USA or I can invest in India. I can convert it into 90 rupees and invest it into India. The interest rate in India is 10%, but interest rate in USA is only 5%. So I think I should invest in USA. I think I should invest in India because there I am getting 10% return, right? Interest rate parity theory says that $1 and 5% interest will be equal to 90 rupees and 10% interest. Therefore, your $1 will be equal to 94.23 rupees in the future. So even if you get 99 rupees, okay, your return is what? Your principal plus return Principal plus return is 99 rupees. You are very happy that I got 10% return. But when you convert it into dollars, what you are going to get is $1.05. $1.05. So in dollar terms, you have still made only 5% ka return. This is called as your interest rate parity theory. The formula is exactly the same. Instead of inflation, you just have interest rate of respective countries, interest rate of counter currency, interest rate of base currency. Okay. Now we've discussed how to read and how to navigate through foreign exchange transaction. We've discussed appreciation, depreciation, foreign exchange risk, etc., and two theories which help us guide and help us approximate and estimate what is going to be the future forward rate or future spot rate. Now we'll discuss how to manage this foreign exchange risk. There are certain practical approaches to manage the foreign exchange risk. Number one, deal in your home currency. You say that I will sell to USA, but I'll ask them to pay in rupees. I'll buy from USA, but I'll ask to pay in rupees. The forex risk is completely transferred to the other party, but the problem is that it might not be acceptable to the other party at times. Okay, if they say that no, I'll pay only in dollars, then you cannot do anything. Then another thing is do nothing approach. See, in the long run, you will make profit on certain transaction, you will make losses on certain transaction. More or less, the forex is reasonably stable. Okay, so in the long run, you are going to win some, lose some. So net impact is going to be neutral. But this is applicable only for small transaction, and it helps you save some transaction cost. But if you're dealing in bigger transactions, if you're dealing with huge amounts, so in that case, even small change in foreign exchange can lead to huge losses. So this is good for smaller transactions and smaller and frequent transactions, but for bigger amount of transactions, this might not be the best approach. Then another practical approach is leading. Leading is in advance. The opposite of that is lagging. Lag. It is delay. Leading is in advance, lagging is in delay. So leading you try to do when you are anticipating that foreign exchange rate is going to change for adverse. Foreign exchange rate is going to change for adverse sometime later. So you want to do the transaction right now. You want to settle the transaction immediately or earlier. So in that case, you can, when you are making a payment, if you are an importer, then it is in your hand, you can make the payment immediately. But if you are an exporter, you are expecting a payment, so in that case you might have to give some early settlement discount to your customer so that they make the payment early. The opposite of this is lagging, in which you are delaying. So if your customer is there, it's very hard to tell your customer don't pay me right now, but if you say okay, they agree. On other hand, if you are an importer and you are expecting that foreign currency is going to go down in the future, foreign currency is going to depreciate in future, therefore if you make the payment a little later, you will be in advantage. So you delay the payment even after due date. You delay the payment for some time after due date until the foreign currency depreciates. But the problem with this is it ruins your relation, it ruins your reputation in eyes of your supplier. So you have to be careful while deploying this. Another technique is to match the receipts and payments. Say you have foreign currency receipts as well as foreign currency payments. So you match this foreign currency receipts and payments against each other. You receive foreign currency, you don't go to bank to exchange it for home currency. You use the same currency to pay to your foreign vendors. Okay, so it is matching payments and receipts. So now let's say you have $1,000 of receipt, $800 of payment. So you only have to hedge for the balance. For $200 of receipt you have to hedge. Similar technique is called as netting, but this is only for intercompany transactions. Oftentimes when you're dealing with foreign subsidiaries, there are some head office charges which you charge, and then let's say subsidiary is providing you certain services, certain goods. So you have this intercompany transactions. What you do in intercompany transaction is you net off these transactions. You say that okay, I owe you 100, you owe me 90, I only owe you 10, I will only pay you 10. This is netting off, it saves you transaction cost. You only have to incur transaction cost on that $10. Okay, this is netting. Another more logical approach for managing foreign exchange risk is, if you have a setup in foreign country, if you have frequent receivable and payable in foreign country, why not open a foreign currency bank account? So you have all of your receipts in foreign currency, you have all of your payment in foreign currency, your exposure would only be for the net balance that remains. And lastly, you have a method called as matching of assets and liabilities. This is a method that we use in money market hedge. Money market hedging is a technique that we are going to learn in this chapter. So in money market hedge, this is exactly what we do. We have a liability, we have to pay, we are an importer, we will have to pay 3 months later. We try to create a corresponding asset 3 months year later by depositing in foreign currency. The opposite is what we do for exports. We will discuss more of that in detail later. Now we discuss the hedging instruments. There are 4 hedging instruments given to you: forward contract, forward exchange contract, money market hedge, future exchange contract, and options. Options and futures are more theoretically based in this part of your syllabus in financial management. They are lot more detailed, they are explained in lot more detail, and the practical questions of that you will experience in your AFM syllabus. In FM, those are theoretical. Forward rate contract and more importantly money market hedge are these two are the most important parts of this entire chapter, which can be tested in practical examination. Money market hedge specifically. Now, how does forward rate contract happens? Forward rate contract, it happens in future. Forward rate contracts, it happens in future rates, in future markets. In future market, right? Forward rate we had seen. So in a forward rate market, forward exchange contract happens. What you do is you go to the bank, you say them that I am expecting a receivable, let's say of $1,000 3 months down the line. I will sell you these dollars. Let's finalize the rate of this sale. Let's finalize the exchange rate right now. Let's finalize the exchange rate right now. So if you are an exporter, you are going to receive payment in foreign currency. You will sell this foreign currency to bank for home currency. Bank will buy the foreign currency and bank will sell the home currency. Okay, so you will see what bank is doing with the base rate. Whatever bank is doing with the base rate, that type of exchange rate you will see. Let's see quickly with the question. Let's quickly see with the question. 13.7 we have. Again, the steps are going to be same. Identify the base currency of in which quotation is given. See what bank is going to do. See what bank is going to do with that base currency, and then do what is required. If bank is buying the base currency, you use the buy rate. If bank is selling the base currency, you will use the sell rate. So in this example, you are an exporter expecting to receive 400,000 in a month. You have the spot rate and you have the 1 month forward rate. 1 month forward rate. Here they are asking you forward exchange contract what it would be. So we are going to use the 1 month forward rate. Now you have the base currency as pound. Okay, even if it is in the right hand side, the base currency is the currency which is given in 1 unit. So base currency is in pound. 1 pound is equal to 1.4550, 1.4565. Now which is the rate that you should be using? Let's understand what is bank going to do with the pound. You are the exporter, you are going to receive dollars, you are going to sell dollar to the bank. If you are selling dollar, bank is buying dollar. If you are selling dollar, bank is buying dollar. If bank is buying dollar, bank is selling pounds. Other way to look at it is, you are an exporter, you are going to receive dollars, you will sell the dollars to the bank. If you are selling dollars, you are buying pound. If you are buying pound, bank is selling pound. So either ways, the thing is, the bank will be selling pounds. If bank is selling pound, we are going to use the higher rate because bank will sell it for a higher amount. So the exchange rate will be 1 pound is equal to 1.4565. This is the exchange rate. How many dollars you are receiving? $400,000. So $400,000, if you have to convert it into pounds, how will you do it? 1 pound is equal to 1.4565. $400,000 is equal to 400,000 divided by 1.4565. These many pounds you will receive. This is how you hedge using forward contract. So today you would have finalized that 1 month later, bank will sell you pounds, at the rate of 1 pound is equal to 1.4565. Is that clear? Is that clear? This is the golden steps. Some golden steps to determine. You will never go wrong if you adhere to these three steps. If you adhere to these three steps, you are never going to go wrong. Identify the base currency. Ask what the bank is doing with the base currency. If bank is buying the base currency, then buy rate. If bank is selling the base currency, then sell rate. Base currency is the rate which is denominated in 1 unit. For import, it will be exactly opposite. You are going to make the payment in foreign currency. If you are making the payment in foreign currency, you will go to the bank, you will ask for foreign currency. So bank is selling foreign currency. Bank is, let's say in this case, selling dollars. If bank is selling dollar, bank is buying pound. If bank is buying pound, bank will take the buy rate. Bank will take the buy rate. Okay. Now we move to money market hedging. This is how you solve for forward exchange contract. Now we move to money market hedging. Very easy, but somehow students get confused in this so much. But let's say we'll make it very easy, very clear. Okay, let's talk with money market hedge. Money market is basically referred to the market of buying and selling of your borrowings and deposits. Okay, this is money market, and therefore you use borrow rate and deposit rates in money market hedge. Therefore it is called as money market hedge. Let's say you are an importer, you have to make a payment. Let's take this with an example 13.8. Test your understanding, number 8. Let's take it with an example. Okay, you are an you are an importer, you have to make a payment of US dollar 4,50,000 in 3 months time. You have to make the payment in 3 months time. These are the rates given to you: spot rate, 3 months, 6 months. Okay, now whether forward contract hedge or money market hedge should be taken. Forward contract we are not going to do, we are going to do only money market hedge. In a money market hedge, forward rates are completely useless. In a money market hedge, you are only referring to the forward rate, to the spot rate. Okay, you are only referring to the spot rate. Now understand these steps very clearly. What did I say? We are going to match the asset with liability and liability with asset. You have to make a payment 3 months down the line. You are here right now. 3 months later, you have to make a payment. 3 months later, you have a liability of 450,000. So in a money market hedge, what I would do is, as a first step, I would say, I need to have a corresponding asset. I have a liability 3 months later. I need to have a corresponding liability I need to have a corresponding asset in foreign currency 3 months later. So I need an asset. 3 months later, I need an asset. 3 months later, I need an asset. Isn't it? So how can I get an asset in foreign currency 3 months later? By depositing here. I need dollar asset. Because I have a dollar liability, so I need to deposit a certain amount here in US. I need to deposit a certain amount in US, so that 3 months later, along with interest, it is 450,000. Okay, so the deposit rate I'm going to take is for US dollar. So let's say I deposit X amount. 1 plus 5% into 3 by 12 is equal to 450,000. So can I calculate the value of X in this case? Yes, I can. See, to deposit, how much dollar should I deposit? 450,000 divided by 1 plus how much is it? 5%. 5% into 3 by 12. So today I need to deposit 4,44,444 dollars. But I don't have this much dollar today. So what I will have to do is, I'll have to borrow it in my home currency. The question is, how much should I borrow? How much should I borrow? I need to convert these dollars into my home currency. Now this is where a lot of students go wrong. They think they are converting dollar to pound. No, no, no. You are first borrowing pounds and then you are converting it into dollars, and that is $444444. Okay, but you would first have pounds. Okay, so what you are going to do is, again, I have pounds. We'll see how much pounds I have. We'll have to figure that out. Exchange rate I am determining. I have pounds with me. I borrowed pounds from my bank. I borrowed certain amount of pounds from my bank. I went to the bank again saying that convert it into dollars. So I am selling pounds. Bank is buying pounds. I am selling pounds. Bank is buying pounds. And if bank is buying pounds, which rate will bank use? Bank will use buy rate. So the exchange rate is 1 pound is equal to $1.7 for $4,44,444. How many pounds do I need? Simple cross multiplication. Simple cross multiplication. So for these many dollars, I need 1.7. I need 261,437. 261,437 pounds. I need to borrow 261,437 pounds today. So the borrowing rate I am going to use is that of my sterling. Okay. A lot of people make you remember these things. Ki export, so you use buy rate. Import, so you read this rate. Export, so you use sell rate. Import, so you are going to use buy rate. If it is if it is an importer, then deposit rate would be of foreign currency. Borrowing rate will be of home currency. You don't have to remember all of these things. You don't have to ratify this. You have to go very logically. If I have a foreign currency liability, I want a foreign currency asset. For asset, I need dollars. I need foreign currency deposit. I need foreign currency deposit. Okay. If for deposit is of foreign currency, then borrowing will have to have from my home currency. I'll need to borrow it from my home currency. This amount I will borrow, and 3 months later I will have to pay this. So borrow rate is 7.5%. So I'll have to pay it 3 months later into 1 plus 7.5% multiplied by 3 divided by 12. Okay, I'll have to pay 2,66,339.87 pounds 3 months later. This is the final liability I will have. No matter what the exchange rate is, this is the maximum amount I will have to pay, and this is why this is called as a hedging instrument. Even if exchange rate goes down, that is, it goes in a favorable direction, I will still have to pay this much. I'll still have to pay this much. Exchange rate has no implication. My final liability obligation has been finalized on day 0 itself. My final obligation has been, in terms of my home currency, has been finalized on this date itself. Okay. So 3 months later, when I'll have this obligation to pay, my deposit would have matured at 4,50,000. I will use the money from deposit to pay off my liability. Both of these things would have been crossed. Only thing I'll have to pay is to my bank for against my borrowing plus interest, 2,66,000. The same way it goes for your exports as well. In case of an export, you have a corresponding asset. In the future, so you try to create a corresponding liability in foreign currency. For creating a corresponding liability in foreign currency, you will have to borrow in foreign currency today. So you will use foreign currency borrowing rate. Now, this amount that you have borrowed today, what would you do with this amount? You have foreign currency right now. You will convert it in your home currency. If you are converting foreign currency in your home currency, so you are in that case, you are selling dollars, buying pound. Bank is selling pounds, so bank will use sell rate. To convert your borrowed amount into home currency, bank will use sell rate. This amount you will deposit in home currency. So this is the deposit rate, home currency deposit rate. Using home currency deposit rate, you will deposit it. Now in future, once the payment is received, you will use that payment to pay off your borrowing, foreign currency borrowing. These two will be neutralized. The only amount you will receive, the actual amount you will receive, is finalized on day one. That is the amount that you converted on day zero plus interest on it, plus home currency interest rate on it. That is the way you calculate for exports. That is the way you do money market hedging as an exporter. That is the way you do money market hedging as an exporter. Okay. The another two methods that I mentioned, futures and options, they are purely theoretical at this stage of your syllabus. And in financial management, they are purely theoretical. In AFM, they will come practical in practicality. So the way in future contracts works, let's understand this. This is the point which comes in theory at times. What is the difference between futures contract and forward rate contract? So understand this. Futures are very similar to your forward contract. The only difference is, there are few differences in that is, your forward contract are customizable. You go to the bank, you tell them how much you want the forward contract to be, you agree on a rate with the bank, so on and so forth. You cannot trade it anymore. You cannot trade and sell this contract to somebody else. The futures contract are just like, theoretically they are just like that. They are for the same purpose. They finalize a predetermined exchange rate for a future date. Okay, but they are traded on future exchange. They are traded on futures exchange. Okay, the settlement happens on 3-month cycle, so they are not for custom period. Also, the contract size is very standardized. The contract size is very standardized. So let's say your sale was for $110,000. For $110,000, your future as an exporter, you are selling futures, but one contract is for 50,000. So you can only purchase two contracts and hedge yourself for 100,000. You can hedge yourself for 100,000. You would not go three contracts and hedge for 150, because then 40 becomes your exposure. Your net exposure to foreign currency becomes 40,000. You will only be able to hedge 100,000, and then 10,000 is your balance exposure. 10,000 is your balance exposure. This you will have to hedge separately. Okay. So the difference between a forward contract and your futures contract are traded on market. They are for standardized size, and because they are for standardized size and standard period, sometimes it leads to basis risk. Certain portion of your transaction is unhedged. Okay. Now let's understand the mechanism of futures. Futures contract, in a futures contract, you take the opposite position. You take the opposite position of what position you need. Okay. So let's say as an exporter, your fear is that foreign currency will depreciate. Okay. So you made sales for $1,000. Now right now $1 is equal to $90. You made sale for $1,000. Okay, let's understand. Let's say the risk is that the rate will go down. The rate will go down. So what you are going to do is, you are going to enter into a futures contract in a way that it gives you benefit once the exchange rate goes down. It gives you benefit with that when the exchange rate goes down. When will it happen? You sell the futures today. For 90. You sell the futures today. Let's say at the time of settlement, the future contract the exchange rate actually goes down. In that case, you will buy future because you have sold futures. Understand that your normal transaction, the normal buy, sell, import, export transaction is different. Your futures transaction is completely different. These are two independent contracts. What you try to do is, from the gains of your future, you try to set off the losses of your main transaction. But it also goes other way. If you are getting a gain on the normal transaction, it will lead to a loss on the futures contract, ultimately neutralizing the impact. So hedging is not done to earn profit. It is done to get certainty. It is to get into a position of no profit, no loss. Again, back to the point, you are an exporter, the exchange rate goes down. You had sold futures initially at 90. now you have to buy futures at 85. Let's say you have to buy, so you have gained 5, you have gained a profit of 5 on your contract, on your futures contract. On your normal transaction, on a normal, let's say you would have done it for $1,000, you would have done it for $1,000, so your total gain is 5,000 plus. Your total gain is 5,000 plus. And on your normal transaction, on the other hand, $1,000 you had, now the exchange rate is 85, so you can only get 85,000 here. You can only get 85,000 here, but you have made a profit of 5,000 in futures. So your total receipt is 90,000. Your total receipt is 90,000. Let's say opposite would have happened. Let's say exchange rate would have increased. You sold it for 90, exchange rate actually increased to 95. So now you have a loss of 5,000 over here. So even if you, in this case, the exchange rate was 1,000 into 95, 95,000 was your receivable. You were very happy. Then somebody reminded you had a futures contract. In that futures contract, you had a loss of 5,000. Your net receivable is still 90,000. So this is how future hedges you. This is how a futures contract hedges you. Whether you make profit or you make a loss, whether the exchange rate moves in favorable or unfavorable direction, your net result stays the same. Your net result stays the same. Okay, this is how you use a futures contract. In import, you do exactly opposite. In imports, you sell. In imports, you buy futures. In import, you buy futures. In import, you buy futures, and then you ultimately on the date of settlement, to square off, you sell the future. To square off, you sell the future. Okay, this is how the futures contract work. Now, there's a additional element to futures contract, which is future options. So option contracts. What happens in an options contract is, you would see that in this scenario, in the second scenario, when the rates moved in the favorable direction, our gain of 5,000 was neutralized because of loss of futures. So option contracts give you a right to enter into a futures contract. It is a right but not an obligation. So you have a to right to exercise to buy a currency at a particular rate. It is a right to buy a currency at a particular rate. It is not an obligation. Okay. So in case of import, what you are going to do, in case of import, this is for import and this is for export. If you are an importer, you are going to get a call option. That is right to buy a foreign currency at a particular rate. Let's say the foreign currency goes down, foreign currency depreciates. So in that case, you will lapse your option. You will lapse your right. You will lose your right. You will say that, okay, why would I go for this higher rate now? The rate has gone further down. I will go with the normal rate. So this allows you to take the advantage of a favorable exchange rate movement. Similarly, in case of exporter, in case of an exporter, you will enter into a put option. Put option is right to sell currency at a predetermined rate, at a particular rate. Let's say the rate you agreed is $90, but later on the rate gets to 95. So you will let the option lapse. You will say that I will collect 95. I will sell the dollars that I have received at 95. Why would I go with 90 now? But if the rate had gone down, if the rate had gone 85, in that case, I will exercise my option. And get the advantage. So it prevents you, it gives you a downside risk, but at the same time allows you to take the advantage of favorable moment. And just like that, we have successfully completed another very critical chapter of your financial management syllabus, foreign exchange risk. I took a little slow and I tried to explain this as logically as possible. Hope this was helpful to you. If it was, please make sure to press that like button. It gives me some encouragement to keep making these videos. I'll see you in the next one. Thank you so much for joining.